I'm Eric Kane, the Director of ESG Research for Bloomberg Intelligence, and for this month's news bulletin, we'll highlight three key items. First, we'll discuss the results of the Federal Reserve's climate scenario analysis. Second, the U.S. Treasury's recent rule related to sustainable aviation fuel tax credits. And third, Exxon Mobil is again in focus as proxy season continues to unfold. I'll then be joined by Ana Moro, a Bloomberg market specialist, who will walk through how to use the Bloomberg ESG climate screen to analyze a company like Exxon's carbon profile and performance. So in May, the Federal Reserve released findings from the pilot climate scenario analysis exercise that it performed with Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, Morgan Stanley, and Wells Fargo. While the results are scant on potential financial impacts for these banks, and the Fed has said the analysis would not have consequences for bank capital or supervisory implications, the report does provide interesting high-level findings. For example, participants reported using climate scenario analysis to consider the resiliency of their business models. However, the approach and data used differed across the group. Further, and this is certainly not a surprise, the participants reported challenges with respect to data and modeling for estimating climate-related financial risks. One finding suggests that overall, 2% of corporate loans had transition risk impacts of more than 500 basis points, while a majority had impacts of just 50 basis points or less. For information on banks' financed emissions, please visit BI Carbon on the Bloomberg terminal. Next, in May, the U.S. Treasury issued long-awaited guidance on tax credits for sustainable aviation fuel under the Inflation Reduction Act. The rule provides a credit of $1.25 per gallon of SAF that provides a reduction of 50% in greenhouse gas emissions and a 1 cent additional credit for every percent that exceeds the 50% mark, up to $1.75. The Treasury rule effectively allows these savings to be calculated in such a manner that would include corn ethanol and other food crop-based fuels, raising questions about the overall impact of these fuels and deviating from guidance under the airlines industry's carbon offsetting and reduction scheme for international aviation, or CORSIA as it's known. SAF and its availability and price are of course crucial to the airlines industry's decarbonization efforts, as we've written about recently at BI. Finally, with proxy season upon us, we once again see Exxon Mobil involved in controversy. Amid a surge in shareholder proposals following an SEC rule change in 2021, the company filed for declaratory judgment back in January to exclude a proposal from Arjuna Capital and Follow This related to climate change. The resolution was subsequently withdrawn, but Exxon Mobil's lawsuit was not, as the company seeks to prevent the SEC from allowing similar shareholder proposals in the future. Exxon's annual general meeting will be held on May 22nd, and the company's efforts to block shareholder resolutions could have major implications. For more information on proxies, please visit BI Proxy on the Bloomberg terminal. And I'll now turn over to Ana Moro to walk through how we can evaluate Exxon Mobil's climate performance on terminal.
Hello, I am Ana Moro, a sustainable finance market specialist at Bloomberg. With proxy season moving forward and lawsuits on Exxon's climate proposal, let's analyze the company climate performance in more detail. Despite being a major player in a high carbon emitting sector, Exxon has shown notable progress in reducing its Scope 1 and 2 emissions, outperforming many of its peers in these areas. However, their overall commitment to climate change remains moderate, with reduction pledges below substantial progress to meet net zero targets by 2050. Interestingly, while Scope 1 and 2 emissions are trending downward, the company's Scope 3 emissions, which encompass the entire value chain, are on the rise and dominate their total absolute emissions. This highlights a significant challenge for Exxon, as Scope 3 emissions are often the largest portion of a company's carbon footprint and more difficult to measure and manage. For more details on Exxon Mobil's climate risk analytics, please refer to the terminal ESG CLIM function. Thank you.
Thanks, Ana. And as a reminder to our viewers, more data and research related to these topics and much more can of course be found on terminal by going to BI Space ESG Go. Thank you so much for joining us, and please stay tuned for next month's bulletin, and we'll see you then. Thank you.